Hey everybody, welcome to Love and Relo, the voice of the relocation industry. I am your host, Ben Cross, and I'm so blessed and honored to be here on a Friday, a special Friday as we're doing a post-election special. This is our third of three specials about the election and about the impact it's going to have to global mobility programs. Today we're talking about tax, corporate tax, mobility tax. We're also talking about relocation policy. I've got three of the smartest people I could find to talk about this. So really excited to welcome to the show today, Jeffrey Gershen from Aprio there. Hey, Jeffrey, how you doing? You guys feel free to come off mute. I muted them earlier. The tax guys were having too much fun backstage, okay? So I had to mute
We're getting
them.
ready, so
You're getting psyched up, getting jazzed. We got David Oltman there from Ineo. How you doing, David?
Hello, Ben.
It's good to have you back here. And we've got Jen Connell from Weichert. How you doing, Jen?
I'm good. Thanks for having me.
And we know we're competing with happy hour. We're throwing tax at happy hour. I don't know what we were thinking here, okay? But we had a lot of content post-election to cram in here. Get in the comments. I want to know what you're thinking. Check in with us. Let us know who you are, where in the world you are, and what you're thinking on this Friday afternoon. If you've got tax questions, corporate tax, mobility tax, or policy, put it in there. We've got people checking in here. Christian Ternedden checking in from Orange County. Again, love taxes. Well, maybe not paying them. That's fine, Christian. Don't worry. The IRS isn't watching. Don't even worry about it, buddy. It's fine. It's a safe space, man. It's totally safe. This is fun. Get in the comments here. Hit that like button. Want to know what's going on in your world. What are you hearing from clients? That's actually a really good place to kind of start. Jen, I'm going to ask you because I know you talk to so many clients from so many different types of industries out there. What are you hearing, as far as their mindset right now going into to 2025?
Yeah, I mean, it's questions that I think people were already discussing very carefully before the election even happened. Is they were already wondering and positioning themselves for how are we going to change our programs, or how are we not even how they're going to change their programs, because they've been doing this for a couple of years, but more like how are we going to move our people and where are we going to find our talent? Because a lot of the policies that are created or developed or changed because of an election of whoever is going to be going into office are largely going to be is going to impact the way we move our talent, the way we're going to source our talent, and even beyond that, it's going to impact their own industries and their supply chains. So it all has a complex impact, impacts their industry, their products, their services, and who they work with, their networks. And it all has a downstream impact on their mobility programs.
I got a question about that. We see questions coming in. Get these questions coming in. Chris Lagerman over here is doing the most. I appreciate you, Chris. But I got to ask you: does whether or not they're going to change and the kinds of changes they're going to make next year, does it have more to do maybe with like macro, like within their industry? Or does that have more to do with their micro kind of economic outlook at their particular company and how well they're going to do, or maybe the talent challenges that they specifically foresee based on where they are geographically?
Is this a question for me?
Yes, I was hoping. Yes.
I think it depends on the industry, but largely all three. I think my feeling is that when I look at I look at specifically, I think. It's pretty well understood that everything is pointing to the oil and gas industry. We're already seeing that industry. Their stocks have already started to indicate the market indicators there. They're already starting to move up favorably as a result of some of the decisions, because we knew where the incoming president is, where they stood on it. The government. That one is, and where the policies are going to be, and some of the deregulation around that. So that is largely an industry-related issue. It always has been, and but also, we have already in our industry, in the mobility industry, we have the honor of being able to work directly with the employees and what their needs are, and what some of the competitive aspects around getting that kind of talent across into areas where people don't necessarily want to live or work. So we work with those companies to find out what it's going to take, what areas of the country they're going to need to be in, and what other countries they need to be in order to grow their business. So that requires new talent all the time, or it needs or move the talent they already have. And how are we going to overcome that reluctance?
Yeah, there's a lot there from a talent standpoint. We talked a little bit about it yesterday on our immigration show. Get in the comments here. I want to hear what you're thinking there. We got people checking in here. I'm going to ask Jeff here in a second about the corporate tax changes here and what he sees coming. Jana checking in from Brazil. She loves the topic. There we go. Erica Massey checking. Drink and talk tax. Nothing better. That's great. I love it. What's up, Eric?
So she's incorporating the happy hour with
Yeah.
Love and Relo. Is this a new concept, Ben?
Honestly, this inspired the concept. I'm like, there's too many of these crappy webinars out there. There's too many of these dry panels out there. We need to capture the conversation and the tone. It's happening at the bar over a glass of wine, 9 o'clock at the conference. That's where the good stuff starts coming out. Okay, so that's kind of what we like to channel here. So yeah, if you got them, drink them if you got them out there. Tom Brune checking in here. What a fantastic panel. Hey, Tom, the jury's out. Let's see how it goes. Feel free to get your questions in there as well, Tom. Rob Zeitz from Wicked Smart, Taxachusetts. Every hour talking about mobility tax is a happy hour.
Wicked.
Wicked Smart, Taxachusetts. What's that about? Jeff Gershen, have you heard about that one, Taxachusetts?
I will tell you, I have not actually seen that written, but I have definitely seen clients and businesses certainly refer to Massachusetts as a very, very high
It's my
tax.
home state.
Oh, man.
It's a very high tax jurisdiction, although there are a few others that would love to be in the running on that.
Yeah, I'm living the dream, so yeah.
I love it. Speaking of which, David, one time, David Oltman, I saw you give a presentation, and this was where I think the first time I ever met you. You were giving a presentation at a regional, and you made a comment. I think I'm going to totally get it out of context here, but it's something to the effect of changing states is about as complicated from a tax perspective sometimes as changing countries is. Is Massachusetts one of those problem countries, or states, I should say?
Yeah, your memory is spot on. It is. If you ask most global tax providers what's the most complicated country to do a tax return in, they're going to say the United States. And one of those reasons is because taxes are so complicated. For example, Taxachusetts, I'm also from Massachusetts. I got married in Massachusetts, so I know it well. They're a state that, generally speaking, has a 5% tax rate. But if you make over a certain amount, they tack on another 4%. So now it's 9% in Taxachusetts. So yeah, your memory's spot on there. Spot on.
I can't believe I remember that. It was a long time ago, David, but it stuck with me because you know why it stuck with me? If we can just go down this rabbit hole for 1 second, it stuck with me. And correct me if I'm wrong, and Jen, feel free to weigh in here as well. Correct me if I'm wrong, but it feels like we're always apt to give an assignee, tax benefits, right? Tax returns and all sorts of benefits when they're moving overseas, but we don't see it. We hardly ever see it on the domestic side. I mean, am I wrong?
No, you're spot on. Generally speaking, I'd say 100% of every company who moves somebody internationally does provide tax preparation services, 100%. And domestically, maybe 25%. But again, I can't stress enough. Any international tax preparer will say the most complicated country in the world to do a tax return is the United States. So it's crazy. I mean, it's changing a little bit, but still, it's a shame that the U.S. corporations are not paying for domestic tax prep because it is so complicated.
So I will add a little bit of maybe I'll make your weekend a little bit brighter there, David. In our advisory services, we're seeing a little bit of an uptick in this. We're seeing more companies that are providing it more on a domestic basis. They're starting to see the value, particularly at the executive and senior levels, because they're the ones that are going to be certainly significantly impacted. And honestly, companies don't really want that noise at the end of the year when no matter how many times you counsel them an employee and say, hey, you might want to consult with somebody on your own. They still come around at the end of the year and say, I didn't realize that this was going to have a negative impact on me from a tax perspective, or I didn't know this could have happened. So as states become very much more in tune with those number of days where you are, we're starting to see more mobility departments and managers saying we should offer this benefit. Particularly, a way to introduce that is in the Core Flex programs, providing that as a flexible benefit to at least for the employee to be able to decide to choose it for themselves.
And Jen, just to hop on that, the average cost to do multi-country tax returns, just throwing out a number, is like $10,000 easily. That's surely a budget. To do domestic tax returns, it's less than $2,000. So it's a fraction of what a company spends to do international. It's crazy.
That's what I say. Yeah, it's a low cost, high return reassurance to an employee. I agree.
All right, wonderful. Love that, and that's been our Ineo infomercial right there. No, just kidding. No, feel free. No, but I want to ask before we get down. We got great questions coming in here. Put those questions in. I see you, Jillian. I see you, Chris. Get them in there. We're going to answer your questions. Before we go too specifically down the mobility trail, though, I want to ask you, Jeffrey Gershen here. Talk to me a little bit from a corporate tax perspective, because mobility starts with business needs and to serve the business. How are businesses feeling, and what types of impacts are the new administration going to have on corporate tax?
Yeah, great question. And it's kind of interesting. And I wasn't thinking that we would have a result today when we first scheduled this. So definitely different perspective. But I think businesses in general, whether they're corporations or partnerships, forget their structure. I think that, they like certainty. They like to understand what they're getting into. They want to understand, what the rule is that they're playing by, because it allows them to plan. They don't want surprises. So, with the results of the election, the other day, I think that, the biggest thing that we're seeing, and again, this is somewhat dependent on where the House result comes in. As of a few minutes ago, I haven't seen a result whether the Republicans are going to take it over. And again, I make no political comments whatsoever. This is merely just facts and what we're reading about. But the biggest thing that I think will occur is, again, assuming that the Republicans get control of both Senate and the House, they obviously have Senate and the White House now, is a real extension of the 2017 Tax Cuts and Jobs Act. And the 2017 Tax Cuts and Jobs Act I could probably talk for 10 hours about that, but then we'd be at bar closing instead of happy hour if I did that. But there's a lot of things that are really out there that should greatly reduce corporate taxes, should reduce taxes for business owners. So we're definitely seeing some of that, and we saw the stock market recently. We saw it again today. Ben, you alluded to that, but things that come in top of the mind, and I'll try not to tax geek out on you, which is really tough for me, Ben. But three things that kind of come in mind are the 199A deduction, which is a really big benefit for business owners, which really gives people an additional 20% deduction depending on what type of business you're in. That exists today. It was set to expire next year. So a lot of industries are very excited about that. One of the big things on the corporate side is Section 174. It's the only code section I'll use today, I promise. Actually, I used two. I think I said 199A, but keep me honest here. For years, businesses have been able to expense research and development costs. Those costs, starting with the 2022 tax year, are now required to be capitalized and amortized. So if you think about it, if a business is doing research or any type of development, whether it be for life-saving medicines or for a new technology or a longer lasting phone or whatever, that the technology or the research that the companies are engaging in gets capitalized to the balance sheet and amortized over either 5 or 15 years. And what that means in real terms for business owners is more taxes in the current year.
So from a cash flow perspective, that's kind of a negative, right?
100%. It's a big negative. So one of the things, and if you Google it, you'll see it'll be top 3 of tax changes that people see are coming down the pipeline, and business owners are very, very excited about that because you'll get that immediate deduction, which will then obviously increase your cash flow. So that's a big area that we're seeing.
Okay, so I'm sorry. So this change would be a net positive or a net negative from a cash flow perspective for a business?
From a perspective, it would be a significant positive for business
Okay,
owners.
Got it. I just want to be clear about that because I had it wrong.
Absolutely.
Sorry, people are serving me drinks over here. Rob Zeitz is proposing a tax drinking game. Do a shot whenever a tax code is mentioned. Interesting. Rob, see, that's what happens to these Cambridge educated folks. They come up with these really innovative kind of things. Just remember, Rob, you got to capitalize that R&D nowadays.
At least today.
At least today. Yeah. We'll play this game in January again, Rob. So now when Trump was running, he mentioned, and I remember the Tax Cuts and Jobs Act, correct me, didn't that bring it from 35% to 21%, the corporate tax?
It did, and there are proposals now to even lower that further. And then additional proposals, if you were going to manufacture and you do the work here in the US, he was proposing to bring that down to 15%. So again, we'll see where that goes. But I think it's important to remember that, that's corporate taxes, and the majority of businesses in the US are not corporations. Most of them are flow-through entities where the taxes get paid individually. So there's a lot of moving pieces here. But
selfishly, I'm thinking about myself right now, and I'm like, wow, that's great, but wait, no, it's not, because it doesn't include me. But when I look at mobility, and I think about Jen, and I think about David and their clients who are in our space, I mean, I got to think that most of the companies that are moving large swaths of employees around are these larger corporations, and they would be this would be beneficial to them. I mean,
it would be. I mean, it definitely reduced taxes means more cash flow. So 100%, definitely something that I think a lot of corporations are excited about. And like I said a few minutes ago, we saw some of those results with the market recently. But again, definitely a positive.
Now, my question though is, and the big question for our industry, besides can we amortize the drinks today for later next year, is that money going to be allocated to these relocation programs? Because part of the Tax Cuts and Jobs Act was the removal of the moving expense deduction, right, David? And are we going to use this windfall that these corporations are going to have moving from 21% to 15%, and this might be a Jen or this might be a David question. Yeah. Are they going to allocate that to offset maybe the gross ups and such?
Well, I'll let you go first, Dave.
Yeah, then I'll give it right back to Jen. I'd say probably not.
They're going to keep the money?
I think they're going to keep it and use it for other things. I think they're going to keep it and use it for other things, but I'll defer to Jen too.
Well, we've seen a lot of cash on the books in the last half decade. Go ahead, Jennifer.
I'm going to say I hope so. in some way, even if it's indirectly. I think what we'd like to see is that it's going to help them to grow their companies. They're going to need to be able to, we may see some reshoring of companies with increased manufacturing. That means they're going to need more employees. They're going to need more plants, and they're going to need more people to run these plants and more manufacturing. That means they're going to need more talent, whether it means relocating people within domestically or bringing people in to do that. So we could see both U.S. inbound and some domestic movement.
You bring up a really excellent point, and this kind of goes back to what Jeff was saying, right? So if I'm a company that is in manufacturing, and I have the ability to manufacture in the United States, and I can take advantage of, let's say, a tax cut that would take me from 21% to 15%, might I, to your point now, bring that manufacturing back onshore? Does that create international relocation? Does that create maybe more talent mobility domestically? Do we see a boom in this in 2025, maybe 2026? Jen, read the tea leaves for me. Don't tell me you don't have a crystal ball, okay? You guys got all the toys up there in Weikert, okay? I know you got one laying around. What do you think?
I got to be careful here, Ben. I think we're definitely going to see some shifts. We will. I don't know that it's going to feel like a boom, to be honest. We've as an industry, we've hoped to see like expansions. We thought we were going to see post-pandemic a huge boom when doors opened again, and it wasn't quite that dramatic. We tend to be pragmatic when we see talent being released to different places as a result of economic times. So I think it'll be very interesting to see over the next year or two where it happens. But I think we have a good pulse on what industries will have the first and second impacts. First wave being the oil and gas. Technology, I think we're going to have an impact. We know that there's the CHIPS Act that will certainly, that is going to have there's already some support and backing behind that. And I think we've already seen certain locations that already going to have a windfall there. But I think that also, whether or not there's going to be a huge boom of inbound because of these changes, I don't know.
I mean, listen, Jen, a stiff breeze would feel like a hurricane compared to the last 18 months. So,
True.
I think we lost Jeff there. I think he just had enough. He's like, listen, all this talk of drinking and drinks and happy hour, I'm out of here. I got things to do. Sorry,
but I'll say this, Ben, is that we've also had there's also something that is not going to go away, and that's the remote work and the hybrid work. And that's also something that it's spitting in the wind for us in mobility is we're still going to contend with that. It's the way people are working now, and that's going to change things. We're seeing certainly more business travel, and that is now part of mobility for all of us. And it's going to require all of us to have a new set of skills, as well as with the influx of new technologies. So being very compliance driven, and also looking out for those geopolitical issues. People are very reluctant nowadays, more than ever, looking out for their duty of care. Is it safe for me to go to some of these other countries, even if it's business travel or extended travel? I don't want to necessarily bring my family with me. So long-term assignments are really not as prevalent as they once were, but maybe I'll go for 2 or 3 weeks by myself. But what's going to happen with my family while I'm gone?
Interesting. Really interesting. We got questions coming in here. David, did you want to add to that?
No, I just wanted to say, I think Jennifer's just hitting the nail right on the head. In other words, there's no question, even during the pandemic, we saw a tremendous amount of moves. I was amazed at the hundreds of thousands of people that moved, even though, quote, the world was shut down. Still hundreds of thousands of people moved. But where Jen's right is by people definitely working from home on the hybrid model. Move went down, but Jen again hit the nail on the head when she said business travels are up and temporary assignments are up. So I'd say it's almost like a wash. Whatever moves we lost because of people working from home, I think we picked up transactions by having more temporary assignments and more business travels. So everything Jen said, I could not agree with more. She nailed it.
You bring a really good point, Jen, and we've been dealing with this whole, work from home trend, and it's kind of going in the right direction, but it feels like it's never going to be pre-pandemic. I mean, it was already kind of macro going there for a long time anyway. But Jeff, I got to ask you, with all these tax changes and tax breaks for corporations and maybe changes in corporate tax, is there anything in this that might incent companies to actually invest in bricks and mortar, to actually invest in having people back in the office?
Yeah.
I mean, is there any tailwind we can get there?
Yeah, great. And I apologize. It was funny. You said you mentioned a hurricane, and then I must have come right off.
I took it personally, but I'm fine now. I'm fine.
No, all good. So my internet must have cut out for a second. No, I think, one of the things that was in the Tax Cuts and Jobs Act is the immediate expensing of equipment and certain improvements in real estate. So I do think that that's one thing that businesses, again, is going to be very cash flow positive. And I think that will encourage, to some degree, businesses to invest in office space, invest in equipment, which ultimately will hopefully bring people back to the office. Again, it's not. I'm drawing some, not a perfectly straight parallel, but I believe that it's definitely something that I think we'll see. I mean, we're seeing it already. Office space. I'm right outside of Washington D.C. The federal workforce isn't back, which is having a direct, impact on businesses in downtown DC, and companies are taking less space. So I think some of these incentives on expediting depreciation, I think will cause companies to do more and will bring people back. That's my hope, at least. I don't have a crystal ball, but I'm not going to say that, but I'll go on record saying that's my hope, and I think we'll start to see that.
Hey, hope is a strategy on Love and Relo, okay? We've got some questions coming in here. I've put these folks off too long. Here, get in the comments if you got questions. I want to hear from you right now. We got Chris Lagerman. Chris has so many questions, Chris. Why don't you just call in and host the show, Chris? Chris says, how will new tax policies impact employee compensation and tax compliance for expats?
So, it's interesting. I read something the other day, and I'd love to get David's thought on this. There was a comment that Donald Trump made on the campaign trail about ending double taxation for Americans living abroad. He made that comment, and some of us tax geeks are looking at it and say, okay, what does he mean by that? So, right now, an American is taxed on their worldwide income, as you all know, right? So if you go overseas, there's the foreign earned income exclusion and what. And I'm a little out of my lane, so David, keep me honest here if I'm wrong. But at the end of the day, if you are living in a taxable jurisdiction that has taxes higher than the U.S., then you're or less than the U.S., I should say, you're responsible for that delta on your U.S. tax return. So there is a little bit of a tax inefficiency, and a lot of other countries don't do that. So did he mean that we're going to move away from a worldwide tax system that the U.S. has? I don't know, but it'll be very interesting to see kind of what that entails, and whether that's just for expats or whether that changes the complete framework of the foundations of U.S. taxation as it relates to doing business overseas. So it's one comment, and there's a lot to it.
David?
Yeah, I mean, the foreign income exclusion is only $130,000, so it's really not a big number at all. And everything Jeffrey said was spot on about. It's all about the delta, and for people who aren't familiar with Delta, not being the airline, but it means the difference, So if the taxes are higher someplace else, it's kind of analogous to states. If you're in California, which is a high tax state, and you move to Illinois, which is a low tax state, you're going to usually pay the higher tax rate unless there's what's called a reciprocal agreement. And that's another thing that gets so complicated. 5 states have what are called reverse reciprocal agreements, which make it very crazy, kind of like Jeffrey on the international side. A lot of times there's the tax law, but then there's the treaty. The treaty trumps, excuse the pun, the treaty trumps the tax law. So it can just get so complicated. It can get so complicated.
It's 100%. You're spot on, David. It can get so complicated, and it's what's crazy to me. And I shouldn't be crazy to me, but I've been doing this for a long time. But people that don't know tax make statements, and then a lot of pundits come out and say, "Well, what does that mean? Does that mean we're changing tax as a whole?" Like, we don't know, but I really think, again, Ben, not to do an infomercial, but it's definitely why you got to work with people that actually know what they're doing in this regard, and talk to David and the team and us and Jennifer and whatnot, because it's very complicated.
And just to pile on, I'd say don't hold your breath. I mean, what was ever stated before, don't hold your breath. I don't see any major changes coming.
I tend to agree with you. I don't really see many changes, because I think it would have far broader impacts to the way we tax international businesses if you made this change. And there was some drastic changes in 2017. I won't geek out on you more, but they did make a lot of changes, and I don't see a lot of that changing as it relates to these one-off comments.
So Chris. Go ahead, Jen.
May I ask a question? So of our 2 tax experts, a question that comes up from time to time, and it actually came up this week, was, and I think this expresses sometimes how people really want to simplify it for them. To your point, people aren't tax experts. Is in our business, we understand the whole balance sheet approach on the international side. On the domestic U.S. side, anyways, they're saying, is there a way to do a balance sheet approach from state to state? And could that become a norm?
Yeah, I'd say, actually, Jennifer, the spirit of most companies is the balance sheet approach. And the spirit is simple. Had you not accepted this relocation, had you not had hundreds of thousands of dollars of taxable income added to your W-2, what would you had paid in taxes? Obviously, based on your moving and having a couple $100,000 added to your W-2, we know what you did pay. So in effect, most companies do what's called a hypothetical tax what you would have paid had you not relocated. And whatever that difference is, there's the word delta, whatever that difference or delta is, that's what companies give as a gross up. And the only little fancy part is, or kind of nuance is, most companies, and I mean, I'm talking most, like 90+%, only calculate gross ups and tax assistance based on employee income only with their employer. However, the spirit of most companies is, if you come back and complain and say, hey, based on my real tax return, I really paid more in taxes than your gross up gave me, most companies would give that extra money. It may require an employee to raise their hand and ask, but when asked, it's really the exception that they're not made, quote, whole, because the spirit of most companies is not to adversely affect an employee because they stepped in an assignment and they got crushed in taxes.
Yeah. And we make sure that the policies do not say make them whole. Everyone who's listening, please.
Why is that such a slippery? Is it just a slippery slope? Make them whole? Like, what does that mean? And
Yeah, it's promising something that's almost impossible to deliver on.
Okay, cool, good.
Mathematically, anyways.
Mathematically, holistically, spiritually,
Yeah,
you can't make someone whole.
It's a very subjective term.
Yeah, for real. This is great. Okay, we got amendments to rules actually for this game. Delta's also now a drink as well, apparently. That's great, y'all. I love the different levels that we're on here. We have some really smart people here. We have some really fun people here. This is great. And we have some people here that, like, hey, I'm early career. Does this even matter to me? Jill says, as a 25-year-old newer to the industry, what changes should we anticipate in these upcoming years? Need a lot of help with this topic. Also from like a personal tax standpoint, I mean, you know, are these tax changes gonna impact, 20, 25-year-old or early career people on their personal basis? Jeffrey, I'm gonna unmute you here for this one.
Oh, thank you. Sorry.
No problem.
Yeah, I mean, look, I'm a tax geek, as y'all can tell over the last 33 minutes, but I mean, will it impact you? I mean, of course. I think that, at the end of the day, tax law changes impact everybody. And, even with the Tax Cuts and Jobs Act, they reshuffled the individual rates. They changed child tax credits. There's lots of nuances within tax law changes. So, definitely something that everyone who's, even if you're earlier in your career, pay attention to make sure that, obviously you're planning correctly, but that you can somewhat see where things are going, right? What should you anticipate in these upcoming years? I mean, I think the spirit of this is a lot of uncertainty. But I think even on the individual side, just as an example, there was a lot of talk about the expanded child tax credit. Again, it's, whether it goes from 1,000 to 2,000, or JD Vance made comments about going up to 5,000. So these are things that may be coming down the pipeline. And I think, everyone should really just keep up with it and obviously know that, these are real changes, and especially people earlier in their career, it could be, $5,000 here, $1,000 here. It could be big money.
And I'd really like to pile on to Jeffrey's comment, especially about the child tax credit. And Jennifer, I kind of want to get your thoughts too. Let's talk about the child tax credit. I have 3 children, and it's $2,000 now. If it went to 5,000, that's even more. But 3 times 2,000 is $6,000. I've never read a relocation policy that says if you move me and add income to my W-2 and I lose my child tax credits because you moved me and added income to my W-2, are you going to give me my $6,000? And because the average gross up's over 100%, 6,000 turns into 12,000. So again, it gets back to what is the spirit of the company? You moved me. You talked about my gross up only based on company income only, but you never said because you moved me, I lost $6,000 of extra money that was going to come my way. And again, if you believe JD Vance, he wants it to be 5,000. The kid, that's $15,000. We haven't even talked about gross up yet. So again, I kind of defer to Jennifer. I'd love her thoughts on when a policy is written, regardless what the child tax credit is. That is a very significant issue that should be addressed in a policy. But I'll turn it to Jen.
So I can promise you, I've never seen anything like that written. And it's explicitly in a policy. At best, it might be covered under the miscellaneous allowance. It's whether it's considered the spirit of the policy. I think this is why companies might be well advised. You may want to provide that provision for some sort of tax consultation, even if you don't want to cover the cost for the preparation throughout, for a year or two after the move, but having that consultation, because you wouldn't want an employee to come back to you at the end of the year to say, I had no idea that something like this was going to negatively impact, because at least it gives them the information to say, wow, this is going to negatively impact me. And they can have that conversation and say that $7,500 or $15,000 if it goes JD Vance's way. You can say, well, listen, you're going to get a raise with your salary, and that increase in compensation, it's your choice. The new job, more responsibilities, as well as the increase in compensation over time more than makes up for that child care credit. It's your decision.
I think your point, and I love what you just said. I'll kind of pile on to that. It's really the whole package. You have to look at everything holistically to see if it makes sense.
And honestly, that's where a compensation expert, that's who you're missing from this, Ben. A comp expert, this is what they get paid to do, is they look at the entire package to say what, and depending on the level of employee, so going to a person who, I apologize, her name's not there anymore, is what she was asking is, what should I be thinking of 4 years from now? Those are the kinds of questions, is Jillian, because it's a great question. In 4 years, and maybe it's not because you're 25 years old, but in 4 years from now, where are we going to be then from where we are now? What changed as far as what tax rulings or regulations actually went into effect, and what made a difference to companies from the things from their bottom line? What actually impacted our industry, how they moved people, and what made a difference. Those are the things that we have to be able to really take a good look at and what measured. Personally,
Jennifer,
my advice to you is invest in your 401k as a 25-year-old. I did it when I started 23. Will never regret it. So.
I couldn't agree more. Jennifer, I want to make sure everyone understands what a tax credit is. Let's say every year you get a $2,000 refund. You're happy. I get $2,000 a year back. Life is good. Well, because of the child tax credit, I've got 3 kids. I'm going to get an extra 6. That means I'm going to get an $8,000 refund. So I am counting on my $8,000 refund. Every tax expert I went to told me, hey, Dave, good news. You're going to get an $8,000 refund this year. And the company moved me. And all of a sudden, my $8,000 refund, I lost $6,000. Now I'm down to 2. That is devastating. Devastating. As you said, Jennifer, companies need to address this upfront. Yeah. That's all. It's significant. It's not a deduction. It's a credit. Instead of getting $2,000 back, you're going to get $8,000 back. And a lot of people don't understand that. We're not talking a deduction. We're talking dollar for dollar credit in your pocket.
And to put that into real terms, a deduction, let's assume someone's at a 25% tax bracket. I'd rather have $2,000 than 25% of $2,000. So it's real money, real cash that you can use.
And it's real money is the kind of things that thing that an employee will go back at the end of the year and say, I didn't realize what this was going to mean to me if they were not specifically told.
Yeah, so and to your point, you also have to remember that a lot of these credits, and I don't want to harp on just this credit, but there's a lot of them out there. They have income limitations, right? So, if you take a higher salary because you're going overseas, and I'm greatly oversimplifying this, or they're moving states, so they move you from Nebraska to New York City, and they raise your salary to pay for that. You could potentially lose out on benefits because your income is higher and you phase out of some of these benefits. So again, you have to look at it holistically.
Exactly. And for the 25-year-old, there's this thing called the American Opportunity Job Credit if you go back to college. And it's $2,500 credit in your pocket. But if the company adds some money to your W-2, you're going to lose that credit. And that's real money. That's $2,500 you would have gotten because you went to school, but you're not going to get because the company happened to move you last year.
How often does that happen? On what percentage of transfers are we talking about?
I love the word that Jennifer said earlier. She said, we're honored to have. And all I can say is I am honored to have countless numbers of clients who send in their tax returns at the end of the year and say, hey, I lost my American Opportunity Credit of $2,500 because the company moved me. So I see it happen all the time, Ben, all the time.
I see it lots of different scenarios. Taxpayers, they'll call me up and they'll say, I'm used to getting a refund of $5,000. And I look at their return and I get on the phone and I'm like, here's why you made, and it just, they're shocked. So again, you got to look at it holistically.
So I'm gonna ask you one more time here to put a number on it. What percentage of returns lose a credit because of a relocation?
Well, I'll answer it this way.
Nobody's gonna fact check you, I swear. Okay, I do want to pin you down because I want to get an idea for it.
I'll make the analogy. If you're a doctor and you're an orthopedist, how many people come to you need an operation? If you go to an orthopedist, they're going to ask for an operation. If you go to a chiropractor, they're going to want to manipulate your back. Because I'm a tax person in relocation, I'd say the only people that come to me are people that lose the credits. So I would say 50 to 75% of people, but it's a little bit jaded because the people that come to me feel they lost the credit, and I usually email them back saying, "You're right, you did."
What's the income threshold, just so I know, and maybe you said it before.
No, great. I'd say the magic numbers are between 150 and 350. If your income plus your spouse's income plus the relocation income is any combination of 150 grand to 350 grand, those
350 jointly. 350 jointly.
Correct. The total tax return, adjusted gross income or taxable income, whatever you want to call it. If you're between that, you're going to be affected. The people that get really crushed are between 350 and 500. And now here's the easy one. If you make over 750,000, you don't get crushed at all. You're in the highest bracket anyways. You never had any of these credits to begin with. See, and that's your point. You can't lose something you never had. If you make 750 grand or more, you're in the highest bracket. So you can't lose a credit because you never had the credit to begin with. You can't be phased out for child tax credits or anything else because you've already lost them. 150 to 350, a lot of pain. 350 to 500, even more pain.
Yeah. So general rule of thumb, generally speaking, you're looking at mid-level folks easily.
And I'll
really
say
interesting.
one thing that I commonly see everyone is when you've got, you're talking people in their mid-20s, 30s, they get married and now their income goes from, call it 150 or 175, and now you add it together and it's 300 or 350, and your income goes completely into a different bracket. You get taxed at different rates. And I probably have this happen 5 to 10 times a year with my client base is, gee, I'm used to getting refunds when I filed singles. Now I got married and I don't get any money back. And you look at it, it's because companies were withholding you at a lower tax rate while you were single. Now you got married and your rate just went way up. So it's definitely, again, you didn't lose anything, but it blindsides people. And that kind of goes a little bit back to Jillian's question about, hey, look, what should you be thinking about? I mean, taxes probably shouldn't be the biggest thing you think about when you're getting married, but again, something to think about.
You see a lot of people just not getting married for tax purposes.
I got to tell you, a funny story. I have. It's not that
I've heard about prenups, but I've never heard about equalizations and
equalization and taxes. No, look.
It's super romantic, by the way.
Yeah, this is totally romantic. You do see it. Oftentimes people in second marriages, they'll equalize it. They think about how to manage the finances, but you do see certain situations where people are very particular about whose tax it is, whether it's mine or yours. And, I don't want to sit and tell you it's 25% or 30%, but a handful every year of clients we see will ask for that kind of analysis for sure.
Love and Relo. Only on Love and Relo do we talk about these things. This is why people tune in. If you stuck around till minute 44, you'd know in your second marriage you need to talk to Jeff. Make sure you're doing it right, okay?
Or your first or your third, whatever.
Oh, your third. Thirds are really big. Thirds are real big, y'all. At that point, you're not working with much after you split it twice, okay? So you really need to be careful with those pennies. Rob brings up a good point, not only about the education, obviously, but tariffs. He mentioned tariffs. And tariffs were a big talking point kind of coming in. And as I'm sitting here listening to you tax geeks over here talk about how basically all these taxes are kind of going away or getting lower to this and that, with the exception of people that transfer and lose all their credits. I wonder, is there going to be any revenue left? Okay, and one of the big talking points was, hey, tariffs. Tariffs are an opportunity to gain revenue, right? People, they were talking China, maybe as much as 60%, which seems like a big number. Other tariffs and stuff like that. So, my question is, it kind of goes to one that kind of Chris made over here. How might trade agreements or tariffs impact relocation plans and business expansion? What are your thoughts kind of on the implications of that, Jen or our tax geeks?
Oh, I'll let somebody else answer that one first if they want to, because that's a tough one. I mean, I can certainly see that in certain industries. I think of retail, for example. That's certainly an industry that has lean margins to begin with. It's we right now a lot of companies here, they offshore some of the production in order to keep their expenses down. In order to bring that back to the U.S., they're going to have to pay those tariffs. And is that going to help to mobilize the talent? They're going to have to, bring that here in order to manufacture. Again, it goes back to the supply chain and being able to reshore some of those operations in order to do that. I could certainly see that. I think some of the cross-border activity should be interesting. We're hoping to see, there's a lot that happens here in North America. In Canada, we've seen certainly a shift into Mexico with talent as well. And we'd like to see that continue in that category too. Will we see it continue or shift to be just domestic and more inbound? I predict that we'll see more activity there. It'll be interesting. Will the tariffs impact it, and will companies be able to absorb that cost? Of course, that remains to be seen. But I think that there may be some resistance. Other countries are going to look and see what are their alternatives.
And you can't use the word tariff without talking about retaliatory tariffs. So you never really know what both sides are. So, I mean, look, I'm gonna play politician for a second and answer your question without really answering your question.
Lovely.
But anytime you add to the deficit, you do tax cuts. And one of the things that's important to note is, you're not going to get 60. Well, let me say it differently. The Republicans didn't win 60 seats in the Senate. So if they can pass bills, but they have to do it through a concept called reconciliation. And I'm not a lawyer, so just if I'm slightly wrong here, bear with me. But the point is, you can't add permanent. You can't add significant permanent changes with a simple majority in the Senate. So the point for all of this is, if you're adding to the deficit, they're temporary. And if you then, in order to mask that, you have to ensure that there's revenue coming from other ways. So one of the ways people are saying that you're going to cover the tax cuts and the extension of the Tax Cuts and Jobs Act, which the reason most of them expire at the end of 25 is because of that same reason. They couldn't get it past that, or else you would extend the deficit beyond what was legally allowed. So the point is, the tariffs are potentially a way to pay for those. So at the end of the day, I think we're going to see, you could see taxes being lowered on businesses and individuals as an extension of TCJA, Tax Cuts and Jobs Act, but tariffs could potentially be increased to pay for that. And where do you end up? Maybe in the same spot. So a lot to see, a lot of interesting things to come, but definitely it's a lot more complex than what meets the eye.
Please hit that like button right now. Get in the comments. I want to know your thoughts on tariffs, on the impact it could have in our industry. What are you seeing from a trend standpoint? We got some really smart people out there, and then we have some people that are just drinking on a Friday, okay? So get in the comments here. Let's see what's going on. Oh, here we found a smart person. Here we go. Joe Cardini says tariffs will increase the cost of goods sold in America. Makes sense. The questions are, will sales suffer as companies are forced to increase their prices? will companies be forced to endure smaller margins due to the increase of the cost of goods sold? And Joe, I'll turn it around on you and say, what's the impact of Relo? But yeah, I mean, those that's the rub, right? It's either increase prices to cover it, or you eat it, and can you eat it? And I guess it depends on the margins that you already have.
Yeah, I think a lot of companies and I think that goes back to the retail industry is a classic example. A lot of them can't endure smaller margins at this point. I think of some of the, without naming names, some of the big box kind of retailers that were already manufacturing goods outside the U.S. The cost to be able to manufacture them here in the U.S. Would have a negative impact on people who purchase them. So, but I think in other industries to be able to bring those here, and I'm going to switch gears a little bit. In technology, we're just basically every industry now. We need more technology talent, and I hear that from our clients. They want more technology in certain areas of their company, in order to advance their products, their services. If they start to bring that more here, or for companies that are outside the U.S., as a result of the election, they might start to change their behaviors, their patterns, not in an unfriendly way. They just might, as a result, they might have their own ways of working that they're going to want to address. They're going to need certain types of talent, but technology talent is always going to be pervasive, and everybody is advancing it. So they're going to have to be able to mobilize that certain type of critical talent, and they're going to have mobility programs to be able to do that. We're not going to see that change, and there's always going to be a competition for it.
Yeah, I could see a pop as people kind of reorganize to say, okay, we need we're going to reposition our business or something, whether it's, bringing it back onshore or go offshore, nearshore, whatever you want to talk about. There's going to be a pop of activity around this stuff, but long term, I tend to agree with Joe. It's just, he says, his analysis of smaller margins typically means lower profits. Lower profits typically mean lower capital expenditures, which typically translates into lower relocation volumes. Quite possibly. Unless this is a long-term trend where you're shifting businesses here or there, and you have to send folks with it. But I believe in every change. I believe in change. There's opportunity, right? And so I look towards this and say, listen, we know there's going to be. Well, I believe there's going to be a lot of change, and with change, there's opportunity. And my question is kind of to end on maybe a high note here is, where do you see maybe the opportunity when you're talking to your corporate clients? What are you counseling them on, and where do you see the opportunity maybe to extract some value from the situation?
I think, I kind of go back where I started. I think that when I'm talking to corporate clients or business clients, I think that, I think Jennifer's spot on. Everybody's a tech company now. Everyone has technology. That 174 was really big. And actually, I've talked to multiple clients this week that are very excited about that rule going away, and they're going to double down on some of the things that they're doing. Maybe they slowed that down a little bit. I'm also telling them, look, tax policy changes is a long process, even if there's majorities in the House, Senate, and in the White House. So don't get ahead of yourselves. Let's not make drastic decisions. Stay involved with your advisors and make sure that you follow what's going on. People a lot of people do knee-jerk reactions, and I say, look, slow and steady, thoughtful planning, I think, is really, really important. We're going to see a lot of changes, but let's not get ahead of ourselves.
Mm-hmm. That's good advice.
Good advice, David.
I think from a gross up point of view and in a tax savings point of view, I'd like to see companies gross up using the minimum rate, which is basically called the supplemental tax rate, which generally speaking is about 22%. And the reason is I still see a lot of people who are significantly over grossed up. And I always feel bad because for every person that's over grossed up, I know there's people that are under grossed up. I'd like to see the money it's overgrossed up given to the people that really need it, who are undergrossed up. So I think the solution is companies should gross up at the lowest supplemental tax rate. And if employees feel they weren't tax protected, have them come back. And it'll save companies literally, if you move just a couple hundred people, you're going to save millions and millions of dollars due to not overgrossing up people. And the handful of people that come back, you'll surely have the money to give them because you just saved a couple $1 million by not overgrossing up people. You have the extra money to maybe give them $500,000 to the people who really need it. So my suggestion is gross up at the supplemental rate, take all that savings, and for the handful of people that do come back and complain, you can surely afford to give them the money.
David, I'm looking forward to T-shirts at WERC next year that say "properly grossed up" on them.
I love it.
Right,
That's
properly
great.
grossed. Okay.
I love it. I love it. That's a great one. That's a great one.
Jen, what are your thoughts here?
So my words would be, look at your current talent. That's where something that we've already been seeing companies looking at over the past year. And it's something that we've been working with companies to really do is, instead of even as companies where they see some growth, if they do, with all of the changes, hopefully if that's what happens, we want to be hopeful, is look at your existing talent. Always look there first. That is your existing pool of talent. That is your future pool of talent. It's always easier. It's less expensive to reskill, upskill what's there already. I'm going to be speaking to somebody soon. I actually just spoke with them recently and going to be speaking with them again about how they take their talent and are able to, by using mobility, to reskill them and give them more opportunities. They have that wealth of information and experience already in-house to be able to shift them here and there. And they already know what their appetite is and actually develop a culture of mobility within their company without taking on more risk of new talent that they're not sure where they're going to be in a few years. It's kind of like, you already know you have a better bet if you were a betting person by working with the people that you already know. We saw a lot of people overspending when they were trying to acquire new talent, and they shed that talent as a result of the past few years when their costs were really squeezed. So that's where I would say look to invest is in your current talent.
Yeah, it's really, really smart. And we see that on the recruitment side. I mean, 21 and 22 was such a hot talent market, and companies were paying 10% more for the same talent than they were paying the year prior. They were doing anything to get folks on board as fast as possible as we kind of came out of COVID and we were drinking out of a fire hose of business and trying to just capture as much as possible. And then all of a sudden, to your point, you look up in 23 and you're like, oh crap, where'd the business go? And now I've got all these bloated payrolls and I got all this capability, but I don't have any demand. And then you saw this right sizing that's been going on the last year and a half. And frankly, relocation has been impacted by that as well, as people have a surplus of talent kind of on their roles. But to your point, it's always cheaper to develop the talent you have than to go out and poach it from somewhere else. Even as a recruiter, I know I can say that with a clear conscience.
But there's a huge value to what you're doing, because then once you know what your own talent is, then you can find the critical talent, and that's where they're going to need you.
Yeah. Hey, come and get it. We got that critical talent. Yeah. Okay, they're very critical. They're very, very critical.
But you don't want to have to hire 90% of your workforce and have that all be new at the same time. Yes. You're trying to expand your business. So
yes, I love it. This has been a lot of fun. Everybody out there, hit that like button one more time. Give this wonderful crew a virtual round of applause out there. Have fun. Enjoy your happy hour, whatever the heck you're doing out there. And I just want to say, Jen and Jeffrey and David, thanks so much for being with us today on this Friday, Talking Tax.
Absolutely. Thanks for having us.
Thanks, everyone.
Thanks, everybody.